Now we know how to record an asset when it is purchased, and cost includes all expenditures getting the asset ready for its intended use. By adding the cost to an asset account, we are capitalizing the expense. In other words, we are deferring the expense of the asset to a future period. The next issue is fixed assets generate revenue in many accounting periods, and they decline in service value over time, with the exception of land. So for example, a car will only last for a specific amount of time. Over this time, the car is used to benefit the company and generate revenues. As a result, we must allocate the cost of the car over its useful life. This is called depreciation. There are several methods we can use to allocate cost over an asset. To allocate the cost of an asset. For this class, we will review the three most common methods. Before we get started, though, there are a few items we need to know before we can depreciate an asset. 1. Cost. Luckily, we've already covered this in the last lecture, but keep in mind, cost, again, includes all expenditure to get the asset ready for its intended use. Next thing we need to know is the salvage value, also termed the residual value of an asset. This represents the amount we believe we can dispose of the asset for at the end of its life. In other words, the asset's value in the future when we are finished using it. And then last, we need to know the useful life. This is how long the asset will actually benefit us, or how long we anticipate it to be used. For example, a computer may benefit or be useful for 3 years. This is considered its useful life. Now, that doesn't mean that it will only be used for 3 years, but we sort of estimate that we will be able to use it for 3 years. So now that we have these three concepts down, let's talk about the most common methods we can use to allocate cost over an asset's life. And again, we call that depreciation. Allocation of cost over useful life is depreciation. The first method is the Straightline Method of depreciation. In straight-line depreciation, we assume the asset consistently generates revenues throughout its entire life. So how do we calculate depreciation using straight line? Well, let's look at these formulas first, and then we'll put the formulas to practice in a future lecture. The straight line formula is the cost of the asset minus its salvage value, and then we divide that by the useful life in years. Pay attention to your order of operations. You must take the cost, subtract the salvage value before you divide it by useful life in years. So once you do that, this gives us what we call our annual depreciation. So this is the amount of depreciation for 12 months, or 1 full year. So that's the first method we'll look at. The next method we're going to look at is the units of production method. This is also known as the units of activity method. This method assumes that units of life is or can be described in units of production. And we allocate costs based on the number of units that we produce or use in a given period. So for example, a car. A good estimate for a car may be the miles driven. You may anticipate that you can get 150,000 miles out of your car. Then you would depreciate each year based on the actual miles the car was driven. Or a backhoe or heavy machinery. Usually heavy machinery has hours operated. So maybe a backhoe will last 20,000 hours of operation, so you'll depreciate it over 20,000 hours. So depending on how many hours you use it in a given accounting period, that is how much you would depreciate. So let's get the formula for units of production or units of activity. Again, we take the same basis here. We take the cost minus the salvage value of the asset, then we divide it by useful life in units. Now once you have that, you need to multiply that number by the units you actually used. So remember we said 200,000 miles on, or 150,000 miles on that car. But if you only use it for 10,000 miles, the first part of this formula would give us the per unit or per mile depreciation. So let's say it's 10 cents per mile. Then when you multiply that by the units you used, you get your actual annual depreciation or the total units of depreciation for that year. So if it's 10 cents per mile and we drive it 10,000 miles, we would end up depreciating $1,000 in that case. So keep in mind this is very similar to straight line, but there's a couple of differences. You divide it by useful life in units. That gives you the per unit depreciation. Then you take that per unit and you multiply it by the number of units actually consumed or used in that accounting period. Okay? That's the second method we'll look at. Now, the last method we're going to look at in this class is known as double declining balance, or DDB. This is an accelerated method of depreciation. What that means is we assume the asset will generate more revenue or be more useful at the beginning of its life rather than later in life. So it's accelerated. If you expect more generation of revenue in the beginning, you want to expense more of the asset's costs in the beginning. That sort of lends to that matching principle. If it's generating X amount of revenues, it needs to match the expense of that generation in the same time period. That's what the matching principle states. So in the double declining balance, our formula for that is we take 2 over the useful life in years times book value. Now 2 is the same thing as 200%. So basically we're doubling the straight line rate. Straight line would be 1 over useful life in years. So in this case we're doubling that, making it 2 over useful life in years, and we're multiplying that by the book value. Now that would give us our annual depreciation. But there's one additional thing you need to understand, and that's what is book value. Well, book value of an asset is calculated by taking the cost of the asset less the asset's accumulated depreciation. Keep that formula in mind for now, but we will discuss more about book value and accumulated depreciation in later lectures when we actually start applying this.